Hello, Steve Lentz here with Discover Options. Welcome to the Prepared Mind. Presented material today is for educational purposes only and should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. If you're interested in subscribing by the time you've finished watching this, please click on the button below. You should know that this is the video blog portion of the blog that appears in the Discover Options blog labeled The Prepared Mind by Frank Fahey. Go to our website, click on the blog feature, and you'll see Frank's excellent blog entry, including a list of double calendar candidates related to stocks with earnings coming out soon. Also, before we get to the reports, you should know that we have a free ebook available to you by Jim Graham and myself. To access this free ebook, click on the link in the at the upper right. Okay. We are going to give you two different reports today, the Condor Butterfly Timing Report for the S&P 500 and then also the S&P 500 Directional Likelihood Report. Two totally different reports with different methodologies that we will explain clearly. Let's go to the Butterfly Condor Timing Report for those of you that like to sell premium in a neutral sense. Okay, and what we want to do is take a look at today's market condition. Actually, the one ending on Friday, and we're going to look at this condition and ask ourselves if this condition is a good one for selling option premium using butterflies and condors. So there's three aspects of the market condition we look at: price action, trend, and the overbought, oversold status. And under price action, we note that Thursday was an upswing day where the highs and lows were both higher than the previous day. Friday was a downswing day with the highs and lows of that day being lower than on Thursday. And then the close was a down close from Thursday. Additionally, trend was above, close was above the 50-day simple moving average, so the trend is up. And in terms of overbought, oversold, we're definitely at the 15-3 stochastic is well over 70. It's actually pushing up near 95 or so. But anyway, we're just going to call that over 70. So when you put all this together, this same condition has occurred in the past quite a bit, and we're going to get to those numbers in just a little bit. But the question is this a good condition for selling option premium? So here's the methodology we use. We like to look at two different volatility levels. One is the actual move that took place over 21 days from a given close. And so here you're looking at a little indicator that tells us that as of a certain close, what was the actual move? All right, so this is the actual 21-day move. We can go up and look at the close maybe here. Okay, and then we have the item here. So over the next 21 days, how far did the market move? And as we can see here, it moved roughly 3.5% over that time. Now, that's when you go, that's the actual maximum move when you go 21 days in the future. So there to there was roughly 3.5% or so. Okay, so that's the actual move. Now what we also like to look at is the move that was implied at that time. Okay, and we then look at the VIX. And what we like to do is split the VIX up into two different volatility levels. One is for the volatility predicted for an up move, and the other is the volatility predicted for a down move. And we use the CBOE's skew published number to help us determine that. But in any case, what you'll see then is the implied volatility is the blue line, the actual volatility that occurred is the red line. And we could see that the VIX is implying a move roughly 3 to 5% generally. And what we've seen in the last couple months is that the VIX has been implying a move greater than what actually has taken place. Okay, so, and this is, look, I'm just showing you this as an example from April and May. But in any case, when this happens, where the implied is greater than what actually occurs, then those bars end up being favorable for selling options premium. All right, and so let's just go and we're going to color these bars blue that are favorable, and we'll color the bars red that are unfavorable. And so whenever you have a situation where the actual move was higher than what was being implied by the options, well, that's an unfavorable bar in that situation, and we would prefer not to have sold option premium during those times. And so here's what we're going to look at is since January of 2000, what percentage of the bars have been favorable for selling options premium? And when you run the numbers, like I've done, and you go back to Jan of 2000, roughly 2/3 of all the price bars end up becoming favorable bars in hindsight. 1/3 of the bars end up being unfavorable. And so that's just flipping a coin, just choosing any bar at random. You'll have a 2/3 chance of choosing a favorable bar, 1/3 chance of selecting a bar that ends up being not favorable for selling premium, where the actual move is greater than what was being implied. All right, so now, of those bars which line up with our actual market condition, all right, of all those bars that line up with the condition we have now as of Friday, what percentage of those end up being favorable? Because look, if we look back and we find out that 100% of them end up being favorable, then we would, we would go ahead and just sell options premium, condors, butterflies all day. On the other hand, if we find out that the market condition we had on Friday ends up being unfavorable most of the time, well, then we're going to back off and maybe not do butters and condors, right? So that's the kind of statistical study we're going to take a peek at, is looking at our current condition. Let's go back in time and find out how many of those and what the percentage was that was favorable. And as it turns out, indeed, quite a bit, almost 10% more of the bars end up being favorable when you look at those. All right. And so 76.7% end up being favorable, 23.3% end up being unfavorable. So our edge here is 9.9%, almost 10% edge there. So in terms of a condor butterfly, now it looks like the current market condition we're in is going to, it's more likely than normal that the bar will end up, Friday's bar will end up being favorable. If you look at the past and look at the behavior of the market, it's more likely than normal that we'll have Friday end up being a favorable bar to trade options premium. So you would want to, if you dive in, you'd want to sometime on Monday morning and near the open do a condor butter. If you buy into this methodology, which I think is very educational and I think is very instructive in terms of learning about the favorable environments for doing this stuff. Now, before we get to the directional likelihood, I just want to make sure you know we have a variety of one-on-one mentoring packages for you. Everywhere from introduction to options all the way up to trading futures options, including an equity track, which gives you the expertise to be able to trade butters and condors, directional option spreads, full understanding of volatility and everything. Check us out. Go to our website and check out this progression. Dip your toe in the water if you want with maybe one of the other courses, the $100 or $200 courses before you ramp it up. And we'd love for you to become one of our students. And we have a great set of professional options trading mentors ready to help you hold your hand one-on-one as you learn to trade options. Let's go to the directional likelihood report now. And let me just take a peek here. Okay. And so here's the current condition again. Like we said, I won't go through it again, but basically, how often has that same scenario occurred and what did the market do? Now, we looked at it in terms of favorable, unfavorable. What I want to do, though, is go into the directional aspect of this. And to do that, what I like to look at is the general distribution of price from every close moving forward, from every close, and get the general gist of the distribution of price. Then we look at the distribution after our condition exists, and then we compare the two. All right, and so how do we do this? We use 3 sets of volatility bands set 5, 10, and 15 days in the future. They're measured 1 standard deviation from the close using a 20-day historical volatility, and they are log-normally distributed. Here's an example. 10-day volatility bands set 1 standard deviation out. Okay, we have the upper band and the lower band, and the question is, over the next 10 days, Is the price going to go up and hit the upper band, the lower band, or wobble in the middle? And in this case, price definitely went up and hit the upper band, as you can see right there. From here to here, boom. So in that case, we record in our database of distribution, our distribution database, that price hit the upper band. Now, let's take a peek over here. What did price do with this from this close? Did it go up and hit the upper band of the next 10 days, or the lower band, or did it wobble in the middle? And in this case, it tried to come down and hit that lower band, close but no cigar when you look real close. So in that case, for that close, we record that it hit neither of the bands. All right, and so from every close, we record how often price struck the upper and the lower 5, 10, and 15-day bands. And indeed, oh, and I didn't do the dates. Doggone it, it's the darn, here. This is as of June. You know, copy and paste is the bane of us, I'm telling you. As of June 3rd, and this also is from June 3rd. Sorry about that. Here are the numbers, and these numbers are accurate. I do know that. So since January of 2000, we've had over 4,100 closes. Price has hit the upper band almost 30% of the time, the upper 10 and 15-day band roughly 23% of the time. It's gone down and hit the lower 5-day band 30% of the time, the lower 10 about 30, and the lower 15 a little higher, 32.4% of the time. So that's the distribution of price in the long term. You know how often price has moved and hit the various band levels. Now look, if we can take a market condition or a technical analysis trigger, you would think then that price after that happens will be different than what you see in front of you, right? After all, if there's a great technical analysis tool out there that's very good at predicting bullish behavior, you would expect to see the upper band hit more often and the lower band hit less often, right? So that's what we're going to do, is we're going to now look at our particular Friday's current condition and see what the distribution was. So I'm taking our situation here, and I've gone back and I've loaded each bar red. I've painted each bar red that conforms to our current condition. And what I like to do then is look at the distribution not only at the close, but if price goes above the high, in this case for Friday, what's the distribution if price ascends above Friday's high versus what's the distribution if it descends below Friday's low, going back in time. And so here it is, out of 100, and this occurred, our current condition has occurred 176 times in the past since Jan of 2000. Isn't that something? That same set of parameters. Out of those 176, it hit the upper 5-day band, 24.4, which is less than the historical distribution of almost 30. And that's why I put in it's a minus 5% there. Okay, it hit the upper 10 19% of the time, which is less than the 23. So that's a negative. Look at this. So it has hit 5 of the 6 bands less often. Less often. That's telling you that this condition that we have produces, has a tendency to produce less volatility in general than the historical distribution of price. Less volatility when you pencil this out. Now, what if it? Let's just look at the. Let's see. This is as of the here. That's as of the close. What if it goes above Friday's high? If it goes above Friday's high, look at this. It tends to not hit the 5-day band near as often. In fact, it hits it less often quite a bit. If it ascends above Friday's high, it's going to hit the upper bands less often, and it'll even hit the lower bands less often as well. So if it goes above Friday's high, you're really looking at a greater likelihood of lower volatility. Not guaranteed, of course, but the likelihood is that it will be that there's at least a likelihood, based upon the past, that it will have less volatility. That's what the takeaway is. Now, if it goes below the low, You can see similarly, though not as much as the ascending above the high, but it will tend toward to have less volatility in general. Now, one thing I like to do is change the band placement and use the VIX, the skew adjusted VIX, to do this. So the VIX is generally higher than statistical volatility. Therefore, the bands are farther out. The upper bands are using a lower volatility than the lower bands because of the vertical skew and the options, right? And so what you'll see here is that the bands are generally hit less often. 21, 16, 14 and a half, 17 and a half, 18, 20, okay? Where we're using skew adjusted VIX figures to set those bands. And even still, we have the at the close that these bands are getting hit less often than historically. Just at the close using our market condition. Again, if price goes below the high, or excuse me, goes above the high, similar numbers, hits the upper bands less often, the lower bands a bit as well, and then of course we go down. If it goes below the low, we have less volatility. At least it's likely to have less volatility even in that situation. At the bottom, I'm showing you the statistical volatility, the upward volatility, and then the downward predicted volatility, using the VIX, using the skew to carve that up a bit and get a more accurate vol number. Okay, so that's what we're looking at. It's just generally less volatility all around. Now, if you're looking for a specific trade idea, here's one we like: hedge to bull put spread. Okay, now keep in mind the downward volatility from the VIX, 16. So what I'm going to do is go to the matrix. Oh, here, I just wanted to show you what I like to do before I go to the matrix. I take the VIX, carve it up into a downward volatility and an upward volatility. 16 is the downward, the upside is at 11.3. All right. In the matrix, I'm going to put that 16% up here in the volatility, the standard deviation button. This sets the width of the standard deviation. We do a bull put spread out here right beyond the 1 standard deviation, and then we do a little hedge up here. Oh, and I didn't get the full number. There's a +1. I'm sorry. There's a +1 in that 2100 put. So this is a bear put spread, a 1-lot bear put spread, +1 -1. Then out here, a bull put spread to make for a total cash flow that is positive. And when you pencil this out and diagram it in option view, you get a nice little bull put spread where you're going to make at least 4 or 5% on the upside, no matter how far up it goes. If it goes down, that hedge is kicking in and lifting up the risk graph as it goes down. And when you look at the numbers, the likelihood that it's going to hit this short strike is roughly 1 time in 10. One time in 1.5 times in 10, something like that, when you look at the statistics up here. Okay, so when you run this out, if we make money here and here, 8.5, 9 times out of 10, and then we lose once, I think you can see that there's a definite edge here. Okay, so that is it for today. That covers both reports. I hope you've enjoyed this. I hope it contributes to your decision making for this week of selling option premium. I'm Steve Lentz with Discover Options. Thank you for joining us. Bye-bye.